Welcome back to Lunch at the Market for this flat Monday. We have two things for you today. Okay, well, three if you count our excitement about the Celtics win last night. But that's really all that we're going to say there, as we didn't get a chance to actually watch the game, being that it took place on Sunday. We're excited for a chance to pick up watching when the series returns to Boston. The first thing that we'll address is your portfolio diversification. We've been going through our portfolios and looking at what sectors we're in right now. It's terribly important to make sure that you're balanced and not terribly overweight any particular sector. We are overweight financials and energy right now, the two places that the market has been hammered. So in the short term, our performance has suffered because of it. If you're looking at your portfolio and you're out of balance, consider cutting back those names that you have little faith in anymore. For that matter, you should be cutting anything that you don't believe in, period, regardless of sector. There's not a market to own stocks that you're unsure about. Ironically, even though energy is a place that we're overweight, we're going to talk about it with you today as we got a question from Mr. Nasdaq about coal companies. The reason we own so much energy is because of the valuations you have right now in that sector. It abounds with single-digit PEs and good cash flow. There are also many good-looking dividends in the sector, and the other reason that we're energy believers has to do with the long-term story of the sector. We think all fuels will be more costly in the future. We also think that these are called non-renewable resources for a reason. Eventually, we will use them up, and as the world population grows and emerging middle classes around the world begin to consume more and more energy, this will put pricing pressure on commodities and those who bring them to the market via basic materials and energy stocks. Looking specifically at coal stocks, they've been obliterated by 1. The Massey energy catastrophe that now seems like forever ago. 2. They're getting dragged down with the market because basic material and energy names are high beta. What the heck does that mean? It means that if the stock market goes down 1%, you'll probably see your high beta energy name go down 1.5% or even 2%. This means that we love them on the way up and they are hated and despised on the way down. Close Natural, CLF, has a 5.18 forward PE and a PEG of 0.45 with $4 a share in cash. Peabody, BTU, has 7.85 forward PE and a PEG of 1.75 with $3.82 per share in cash. Massey Energy, MEE, has a forward PE of 6.12 and a PEG of 2.04 with $11.54 per share in cash. Alpha Natural, ANR, has a forward PE of 7.01 and a PEG of 0.68 with $4.70 per share in cash. Arch Coal, ACI, has a forward PE of 8.73 and a PEG of 0.9 with 31 cents per share in cash. Looking at those numbers, CLF has the best valuation for sure. The PEG for MEE is of some concern, but then it has the best cash position of any of the coal companies. So stick with either CLF, BTU, or MEE for your coal plays. Just remember, energy is hated right now, so there may be further pain. If you're underweight energy and need exposure in the next big down day, with the Dow down 100 points or more, check out these three coal names as they're cheap now. With another 100 points off the Dow, they should be even cheaper. Thanks for tuning in today, and we'll see you tomorrow.